the black line there, and that's the vault stocks of silver. And so that decline there is the equivalent of approximately 16 million ounces of silver declined since mid-December, while the blue line is showing the share price has gone up of the order of about 30% at the same time. So, since when do we see a declining interest by investors in an asset which is rising 30%? It doesn't make sense.
Monaco 64, home of alternative economics and contrarian views. Well, we have David Jensen back. David, welcome back to the channel.
Thank you, Mario. Always great to be back.
Yeah, always great to have you. And I was looking through the YouTube studio that I have, and we started talking about the markets. And the first time I interviewed you was in September of 2024. And you said at the time that the London bullion market has sent gold and silver supply to the moon. And thereafter, you've been warning. Like the second video we did in January of last year, about a year ago, you said London silver market verges on silver delivery default. Then you said an absolutely massive fraud that has been perpetrated for decades. And so on. I'm going to put, we've even got a playlist for your interviews now, David. So I'm going to tell the viewers to check it out. I'm going to put it up here in the cards and they can watch. I think we've got about 10 videos. This is going to be the 11th interview. And we spoke recently, just before the new year, and you said that there's no more like central silver market, everyone scouring the planet for physical silver. And I see here in your Substack, which I highly recommend to the viewers, I'm going to put a link below in the description. It's called Jensen's Economic Precious Metals and Markets Newsletter. You said on January 14th, silver price run is driven by increasing silver shortage globally. So maybe we can start with that because we see a lot of people who haven't been following silver, who are into other markets. We see them commenting and saying this is a bubble, it's going to collapse. But from what you wrote here, this is not driven by greed or speculation. It's driven by fear that there's no silver out there.
Yeah, I think that is the underlying driver of the demand that we're seeing right now for silver, as well as, of course, the whole concept of the debasement trade in terms of people trying to secure assets, as we've seen the incredibly reckless and loose monetary policy that have been operated by the central banks for decades now, but really it's coming to a head now. I think people can see that there's incredible pain in the Canadian and US economies right now. It's not shown in the overlying numbers, but there are very strong indicators that the consumers are suffering. And I think that on top of the fact that there's an awareness of this problem in the market is combining now to drive people to secure physical metal. I think that it's been a long time coming. It's amazing how long information diffusion takes, but once it gets a grip, man, does it ever move fast. And I think that we're, the stuff we're talking about now quite widely in the markets. 5, 6, 7 years ago, I talked to people about it, and they would look at me like I had two heads. And so it's funny to see it becoming mainstream and seeing the buying of the physical metal going mainstream as well.
Yeah, and I was telling you before we started the interview that I had gone out, and we're speaking on Friday, actually. Friday afternoon London time is just around 11 o'clock Eastern
Yeah.
time. And I told you I took Rudy out about just over an hour ago. And when I left, gold was trading at 46.20, I think. Silver was approaching 90. And then I
Yeah,
got back, everything had changed. Gold had dropped to like 45.50.
yeah,
Silver had dropped to like 87.30. And I was wondering what was going on. I mean, I wasn't too surprised, David, because we've seen, especially in silver this week, we've been silver relentlessly going higher, not just in China or in Shanghai, but also in the West. But
hmm,
once in a while, we see, especially overnight London time, we see a huge smackdown and the price drops precipitously, but then it recovers during the day. And like yesterday, for example, I think it was it the day before yesterday, we dropped to like 86, and by the end of the day, we're trading around 92. So you were telling me that there's some options expiry today in
yeah,
SLV or maybe the silver futures. Could you explain to the viewers what's going on here, what
right.
the market makers, the bullion banks are trying to do?
Sure. Well, options are basically leverage bets on the directional bets on what is going to happen with a stock, and we've seen the miners, especially select miners, have extraordinary runs higher in their price here over the last 30 days. And what we're seeing today, Friday, is the options expiry day for January in the U.S. And banks and their trading houses have been shorting mining stocks into the market as they usually do, and they are facing material losses now in terms of providing liquidity in this market in terms of selling these options. And my instinct is that we're going to see heavy selling in the New York market, the CME market for silver, and in the silver equities today in an attempt to limit the losses that they face. So hasn't been a good 30 days for them, that's for sure.
Yeah, and as we speak here, Dave, I've noticed that we're almost back up to 4,600 in spot silver. Sorry, spot gold, and
Yeah,
silver is almost back to 89. So it
yeah,
looks like they're going to have a battle royale on their hands to keep these markets lower. And
yeah.
like you said, it's all about physical. And could you also talk about, you just put something out just before we got together here to have a chat. You wrote, and I'm gonna bring it on here, share it, uh, share the post with you guys. And David says Shanghai silver price still over $100 per ounce as SLV ETF is rated for physical silver bars. So could you go over what's going on here?
Yeah, so I mean the demand, it's a global demand for silver. And what we're seeing is the Shanghai price closed today, Friday, at $101, equivalent of $101 US, and that we're still seeing a mid-teens price premium in India for silver. And so when you have that kind of a price differential, it's going to draw physical silver with time. It takes time, but it draws physical silver because of the arbitrage there to meet the market demand. And so what is interesting is that over this time that we've seen the silver ETF, maybe you could just scroll down there to the diagram that's below that. So there you can see the increasing premium. So we've got like 89 versus $101. That doesn't work over time, first of all, right? It just doesn't work to have that kind of a price spread between these two physical markets. There are transportation media in the world that will solve that problem. But what's interesting here is this looking at the SLV, which is the world's largest silver ETF. I think they hold of the order of about 550 million ounces of silver in their vaults, or it's held for them by their custodian, JP Morgan. But so what we can see here is that since mid-December, so I've highlighted the black line there, and that's the vault stocks of silver. And so that decline there is the equivalent of approximately 16 million ounces of silver declined since mid-December, while the blue line is showing the share price has gone up of the order of about 30% at the same time. So, since when do we see a declining interest by investors in an asset which is rising 30%? It doesn't make sense. But there are these things called authorized participants, which is basically banks, bullion banks, who participate in the ETF, and they can turn in baskets of shares. I believe it's 10,000 at a time, or 50,000. I can't remember. But they can tender these shares and receive these 1,000-ounce bars at the exchanges in return. And it looks to me like the silver shortage is getting so intense that every means possible is being used to secure physical silver to provide liquidity to the exchanges.
So they're raiding the SLV piggy bank to deliver silver in other markets. I mean, yeah, shouldn't that worry people who hold SLV, even though for retail investors, you're not really eligible to get delivery?
Well, I mean, having read The Great Taking and looking at globally at bank balance sheets and seeing how leveraged the bars are to the debt markets, like I am not personally, and this is not investment advice, of course, but I am not a proponent of holding equities or any financial instrument in the market over time. I think one would just be asking for it, given the backdrop that we see with the instability globally. So the whole concept of silver and gold, and I think especially in the time to come, is to hold it directly in your legal possession through whatever means is best for people. But I think the future here is about physical assets and separation from what I believe are fraud centers in the financial markets.
How do you think it's going to play out going forward this year? I don't see any solution to this
No.
shortage of physical silver. So I continue to see the price go a lot higher,
Yeah.
even though there are a lot of naysayers there, of course, who don't really know what's going on and keep saying, oh, the RSI is overextended, this and that.
Yeah.
Yeah, could you give us your opinion on things? And I don't know if, of course, it's difficult to give a price, but
Yeah.
yeah.
Well, no, I agree. We're seeing basically a transition of, and this is just at the margins, but it's enough to affect the market because of the leverage in the market, right? The paper claims versus the actual available physical globally, that we're starting to see people vote with their feet and securing physical metal. And I don't think that looking at any of these market indicators or pricing indicators such as RSI, relative strength indicator, it matters right now. What we're having is basically a sea change is underway, and it's not day-to-day trading activity that is measurable in any way using these market price stochastics. So yeah, I think that we're heading into a new world, and that the physical shortage is driving a problem globally, which is insoluble at current prices. And but I see these metals moving up by many multiples in terms of fiat price. But I see an intense shortage building now in the market in terms of availability. I had an interesting talk this week with a large bullion dealer, and really it was interesting to hear. Like Perth Mint right now has no silver bars for sale. They're only selling 1 ounce coins, and the Royal Mint in the UK there has no bars, silver bars for sale at all. They're only selling 1 ounce and fractional silver coins. And the US Mint, despite the fact that it's legislated to provide silver coins, bullion to the market in whatever quantity is necessary to meet market demand, they're delivering silver to the market at 1/6 of the rate that they were providing it in 2024. So we're seeing, a decline there. And on the Canadian Mint side, last year in 2025, this dealer said that they produced 100-ounce bars for 2 months and produced 10-ounce bars for 1 month into the market. And the other thing that was really of note was that some of their clients had been debanked for buying silver and gold from them, and they were told that their accounts were being shut down because they were making material purchases of the metal from this bullion dealer. So that kind of speaks of a desperation when a bank is debanking long-term clients because they're making physical bullion buys, because this stuff is the kryptonite to the leveraged system that the banks have been operating, and clearly in desperate straits when you try to do that kind of stuff.
Yeah, they're not happy when you ask for delivery. I remember about 20 years ago, maybe a little more, my mom had an account with a bank, American bank in Switzerland. And I had power of attorney and I bought some gold through them. And at one point, a year later, I called the bank and said, "Oh, I'm coming to Switzerland. I want to take delivery." And they went crazy. They said, "Why do you want to take delivery?" And I said, "Well,
Right.
because it's my gold." And
Right.
eventually they told me, "Oh, this is FX gold. It's not real gold."
Right.
Yeah, they hate it anyway.
Yeah.
But
What,
talking
what's
about
interesting, what's interesting, Mario, is that, sorry for interrupting.
no,
What's interesting is that a bank is a service provider. It's a third party to a transaction, and that they're actually monitoring their client transactions and then debanking clients who are buying physical metal. I mean, it's one hell of a concept to me. Maybe I'm not keeping with the times here enough in terms of the changing definition of what is appropriate behavior by these commercial entities.
no, I agree. And talking about banks, there's been a lot of rumors that yeah, we don't really know. Like some people say, oh, the banks they're long long the metal physical, and they're short the futures, uh,
Right.
and other people say, well, UBS is short 2 billion ounces, or JP
Yeah.
Morgan has 700 million. Citi and Bank of America are in trouble. I know it's impossible to know exactly how these banks are positioned, but what
Well,
is
we
your
do.
feeling?
We do have one data point that's put out by the CFTC in the U.S., the Commodities Futures Trading Commission, and their latest commitment of traders report, which they give a report. So that's from January 6th. So I mean, they're always a little bit slow on this stuff. But what they're indicating is that what they call swap dealers, and swap dealers are it's kind of a code, but they're basically the bullion banks. And what they're showing is that the net short, not the short position, but the net short. So their shorts minus their longs, they are net short the market, the silver market, by 26,000 COMEX contracts. So that's 130 million ounces that they're short, net short to the markets. So now the argument is always made that the banks run a balanced book, and so what they typically do if they're short or net short the U.S. market, the claim is made that they're long the London market in terms of holding spot contracts, so that they have a balanced book. But I put forth the argument that if you can't get delivery on London, what good is your hedge? What good is your long side? And the thing is that if this London market goes long, these swap dealers can be on the hook for the entirety of their short position in the U.S. market, right? And their short position is of the order of about 60,000 contracts for the swap dealers. So they've got their longs minus their shorts, and so 60,000 contracts is 180 million ounces in just the COMEX market. And then there's the entire issue about the London market as a whole, and the gross selling of paper into that market. And I don't mean that as a technical term, I mean that in the vernacular, but just the obscene level of selling of paper claims to buyers for silver ownership and immediate ownership and immediate delivery, which is of the order of about 2 billion ounces. So the global this growing welter for physical delivery globally, which is a North American feature, it's an Asian feature, and it's a European feature now, speaks of what I believe is a certain demise of these entities and of these leveraged game playing exchanges that have been created over the decades.
Yeah, so basically up until you remember, I guess, well, early last year, the gold for delivery on the LBMA, the
Yeah,
allocated gold, the spot gold, the delivery was 4 to 8 weeks delayed. And I
yeah,
think, David, that's what triggered this whole crisis for them,
yes,
not for us,
yeah.
of course. And the same thing is going on for silver. So when they tell us that the banks are hedged, they're hedged, but they've got a contract on the LBMA that's become worthless. So they're in deep trouble, I think, wouldn't you say?
Yeah, I'd say they're on the hook. By the way, I just realized I made a very simple math mistake, that the short position is 60,000 contracts, which
That's
translates to 300 million
Yeah,
ounces,
300 million. Yeah,
not
it's
108,
5,000. Yeah, yeah,
right? Not
yeah. I
180
was
million.
thinking
Yeah,
about that. Yeah,
yeah. So 300. It's a
huge.
300 million exposure plus whatever the exposure is from these
Yeah,
betting houses in the London market. So
that's more than
it's a lot of dough.
that's more than a third of annual silver production, isn't it?
Yeah, the silver mine production is
Yeah,
825 million
yeah,
ounces a year,
yeah.
right?
Oh, yeah. And talking about silver mine production and the fact that you said, and we know that the only way to stop the shortage is to allow the price to rise so we can
Hmm.
find a price clearing level.
Yeah,
But how long would it take, though, to actually start seeing the supply match, the demand?
yeah.
Because I guess a lot of people might sell their physical, which I don't
Yes, they
recommend
would.
unless you desperately need to. If anything, you should be buying to really put a dagger in the back of these banks. And that's, of course, an analogy. It's not literally. But yeah, so how long do you think it will take to normalize the market? And do you think once it's normalized, the supply and demand, the price will stay a lot higher?
Well, I mean, we know right now that the demand for silver is increasing. And even at the current levels right now, never mind the fact that day by day and week by week the demand is increasing, the major European refineries are running 3 shifts, so 24 hours a day, and they're running 7 days a week, and they are unable to convert the above ground silver stock into the 1,000 ounce, three nines or 4 9s bars that are required for the exchange delivery. So they are really acting as a throttle or a choke point on the movement of the above ground silver stock to the exchanges. So we need we need more refineries, and we need more distributed refineries. There's a serious problem in terms of the U.S. not having enough silver refineries. They've just got a couple, and then some smaller regional ones. But like Asahi is basically the dominant refinery in the U.S. There's just a couple of refineries there. But we need refineries, many refineries, and we need, quite frankly, our own smelters right now. I think it's 70% of the mine supply is being funneled through Chinese smelters. So we need smelters, and they don't have to be major, major infrastructure projects. Just a highly distributed, smaller smelters would be just fine. And there are many smelter designs now, be they natural gas or electric smelters, that can meet the requirement. So, but to get back to the nub of your question is that it takes time. This is not something we're going to turn around overnight. But there are large silver stocks in vaults that could be brought to market with the appropriate price. But clearly, the game playing we're seeing today and the sub $100 price is inadequate in terms of providing appropriate liquidity to the market so we can meet this market shortage. We need multiples higher price from where the price is today to clear the market. And the bullion banks have their vested self-interest, which is to not blow up. And this is why we see this continual game playing going on. They're interfering with proper market function. And if we had any kind of regulatory oversight, it would be stopped. But between the revolving doors and interference from government regulators, regulatory authority, maintaining the interests of the government overall, the market is not being allowed to function properly. That speaks of basically rupture that occurs after that kind of interference. So I think that's what's going to come to this market.
Yeah, so multiples of where we are. So a lot of people have been talking about 200, 300, or even $600 silver. So
It's hard
yeah,
to say, right?
yeah, but I wouldn't be surprised. I don't want to guess a number. As for smelters, there was some news late last year, and I'm reading here from Google, U.S. government smelter announcement from December 2025 involves a major partnership with South Korea Zinc to build a 7.4 billion smelter in Tennessee. But it's
Right.
for minerals like zinc, germanium, gallium. Nothing about silver there, but it looks like they're starting to get the idea that the world has become too dependent on China.
Yeah, the
And
U.S. has two zinc smelters. But typically, when you're mining for zinc, you're also finding lead and silver with it. You're mining what are called galena ores, oftentimes, and you get those these polymetallic type of deposits where you get multiple metals. So if you're recovering zinc, you're going to be recovering silver. It's hard to avoid it.
so I guess that's a start, and that's a
Yeah.
good thing.
And there is an existing zinc smelter I think it's actually the largest zinc smelter is in Tennessee right now.
Okay, okay. Great, David. Could you tell the viewers what they should be focusing on if they're stackers, if they have physical gold and silver, and also the miners. You said you mentioned the great taking, and that is a worry. I do have mining stocks, and I don't have their certificates. Maybe I should think about doing that. I interviewed Bill Holter the other day, and he said that's
Yeah.
imperative. I'm not trying to panic the viewers, but yeah, that's something they need to think about. But anything else you want to add before we wrap up?
Well, I think if a person is a stacker, which I think is a good idea, and they have enough metal, I would just turn off your computer and go for a walk and enjoy the day. Every day is a gift. If people are stackers and don't have enough metal to meet their personal targets that they have determined, then I think it might be a good time for kinetic action in terms of acquiring more until they've met their personal goals. And the situation is what I would call metastable, and it just takes an input to kind of push it into a condition of dysfunction. Let me put it that way, in terms of not being able to get metal. And it's funny because I monitor a number of bullion companies, metal companies here in Canada and the U.S. in terms of availability, and some of them are, which I've never seen before, are utterly and completely out of all stock, and everything that they're providing is with multiple week or month delays, and some are even starting to cancel orders and just saying that they just can't meet the request and returning the money to the purchasers. So it speaks of a highly dysfunctional market, as we would expect when you've got price fixing for decades, and that period of price fixing is coming to an end. So I think that if you have goals that aren't achieved in this sector, now is the time for action.
No, I agree. And the term unobtainium comes to mind, David. People have been mentioning that for years.
Yeah.
And it looks like, yeah, the retail sector will be the first to suffer because governments and big money, they will get the physical before we get it.
There is a lot of silver above ground, and we're with the price reset that is coming. And I don't think Klaus Schwab was talking about the silver market, but I think it's inevitable that we're going to have a price reset, that this stuff is going to start to move, and you're going to see it moving in very, very interesting ways. And because of the destructive input of government currencies, or the destructive impact of government currencies on society as a whole, I think it's inevitable that these billions and billions of ounces, and there's 25 billion ounces above ground in total in all applications. But it's inevitable that these billions of ounces that have been frozen as a monolith now for decades because people have forgotten about it, that as the economy and as the currencies decline together, that we're going to see a rotation of this metal throughout our economy, and it's going to operate as a parallel payment system, much to the chagrin, I think, of our central planners.
Well, and yeah, again, keep a hold of your silver, physical silver,
Yes.
because you regret it, I think, in my opinion. And this is not advice, but it's what I'm doing, David.
I totally agree.
Well, David, it's always great to speak with you, and I wish you a great weekend, and we'll speak later.
Sounds good. Thank you, Mara.
You're welcome.